Greetings everyone, Puneet Verma here along with my teammates Krishnacharan, Gautam, Nishant Verma. We are going to present about portfolio optimization, which is a crucial topic in financial decision making. The aim of the portfolio optimization is to determine the best possible allocation of assets in order to achieve the maximum returns while minimizing the risk. This concept is not only theoretical but also highly practical. Every investor, from individual retailer investor to large institutional asset managers, faces the challenges of balancing risk and returns in their portfolios. Next slide. Let me start by explaining why portfolio optimization is important. Uh, Financial markets are inherently uncertain, and every investor decision involves some level of risk. The goal of the portfolio optimization is to find the most effective way to allocate resources among different assets, balancing the trade off between the risk and the return. Our project focuses on applying optimization techniques on three assets. The three assets were chosen to represent a spectrum of risk profiles. And then the companies we started with is Microsoft. From here on, I'll refer it as MSFT, which is a technology stock with high growth potential but significantly volatile. And then VTI, a fund offering broad exposure of the US equity market, representing moderate risk and stable returns. And then S&P 500 index, which is a benchmark index that reflects the performance of uh, largest US companies offering low risk and stability. Using these three assets, we developed three optimization models. And the first one is the risk minimization model, which is designed for conservative investors whose priority is to stabilize the returns. And then the Sharpe ratio maximization model, which balances risk and the returns, making it ideal for moderate risk investors. And then the last one is the return maximization model, which targets aggressive growth and is suited for investors willing to take higher risk. Our work is grounded in modern portfolio theory, which emphasizes diversification and the efficient allocation of resources to achieve an optimal risk return balance. Next slide. To understand the foundation of our work, let's dive into the literature. Modern portfolio theory, which is developed in 1952, introduced the concept of effective frontier. This frontier represents the uh, set of portfolios that offer the highest possible return for a given level of risk or lowest risk per given return. And this theory was revolutionary, but it also had limitations. For instance, this theory relies on historical data and assumes that the assets return follow a normal distribution curve, which is not often true in the real world markets. It also assumes linear relationship between assets and then ignoring non-linear correlation in the market dynamics. To address these gaps, researchers have developed advanced techniques, including robust optimization, and then multi-objective optimization, and then machine learning approaches. Starting with robust optimization, this method accounts for uncertainty in data, making portfolios more resilient to unexpected market changes. And then uh, when it comes to multi-objective optimization, it balances conflicting goals such as maximizing returns while minimizing the risk. And then when it comes to machine learning approaches, these uses predictive algorithms to adapt to portfolios dynamically to changing market conditions. And then next slide. Our project has three primary objectives: to construct optimized portfolios tailored to different investors' profiles and risk tolerances, and then to evaluate these portfolios using key metrics such as expected returns, portfolio variances, and the Sharpe ratio. and then to provide actionable recommendations for the investors based on our findings. And each of these objective addresses a specific type of investors. For example, conservative investors likely to prioritize risk minimizations, seeking stable returns in a volatile markets. And then when it comes to moderate investors, they aim for balanced growth and the stability, which aligns with maximizing the Sharpe ratio. And then when it comes to the aggressive investors, uh, who are willing to accept higher risks in pursuit of higher returns, making the market minimization model suitable for their needs. Next slide. To achieve our objectives, we relied on historical price data from three aspects: asset, MSFT, VTI, and SP 500 index. The data is sourced from reliable financial databases, ensuring accuracy and relevancy. By using a mix of individual stocks, ETFs, and indices, we are able to analyze assets with varying risk return characteristics, and the historical price data spans several years, allowing us to capture market trends, volatility, and the relationship between assets over time. This comprehensive data set provided the foundation for our analysis, and then for the optimization of the models. From here on, Nishant Verma will continue.
Hello everyone. So coming to the formulation of optimization models. So to address the objectives of our project, we developed three optimization models, each with a distinct goal. So each model is built around the decision variables. So these are the portfolio weights assigned to each asset and also the objective functions. For example, minimizing variance or maximizing returns, and also the constraints. These include ensuring the sum of weights equals one and that no weight is negative. Uh, so these mathematical formulations allowed us to determine the optimal allocation of assets for each model. So next slide. Yeah, description of algorithms used. To solve these optimization models, we used algorithms tailored to each model, which is a risk minimization algorithm. This uses quadratic programming to minimize portfolio variance. The algorithm calculates weight that reduce overall risk by considering the covariance between the assets. And the second one is Sharpe ratio maximization algorithm. This employs nonlinear programming to find the weights that maximize risk-adjusted returns. It is more complex due to the nonlinearity of the Sharpe ratio. The third one is the return maximization algorithm. This uses linear programming to maximize expected returns while adhering to constraints on risk and diversification. Each algorithm was implemented to ensure accurate and efficient computation of optimal portfolio weights. Next slide. Coming to the summary statistics, we calculated key summary statistics for each asset to understand their risk return characteristics, which is Microsoft MSFT, which has the highest mean return but also the highest volatility, reflecting its growth potential and risk. And the second one is VTI. We demonstrated moderate returns with relatively low volatility, making it a stable choice for balanced portfolios. S&P 500 showed the lowest volatility and a nearly flat mean return, highlighting its role as a low risk benchmark. So these statistics provided us the valuable insights into asset behavior and also informed our optimization models. Next slide. So coming to the visualization, historical asset prices, we see that this graph illustrates the historical price trends of the three assets, which is MSFT, VTI, and S&P 500. Coming to MSFT, we can see that it displays significant growth over the period, but with pronounced fluctuations, indicative of its higher volatility, and VTI, which shows a steady upward trend, reflecting the overall stability of the US equity market. S&P 500 exhibits the least variability, underscoring its low risk nature. So by analyzing these trends, we are able to identify the growth potential and also the stability of the each asset, uh, which directly influence our portfolio construction. Thank you. Now, my friend Krishna will continue the next part.
Hi, here coming to the slide 10. Here I'm going to explain about the visualization correlation matrix of returns. This slide presents the correlation matrix of returns for the three assets in our portfolio. Microsoft, which we're going to represent now as like MSFT, and Vanguard Total Stock Market ETF, and the S&P 500 index. Correlation is a statistical measure that indicates the degree to which two assets move in relation to each other. Here's what the correlation matrix reveals. VTI and the S&P 500 have a strong positive correlation. This is expected since VTI represents the broader US equity market and the S&P 500 is a key benchmark of large cap stocks within that market. And the Microsoft and the other two assets have moderate correlations. This suggests that the while Microsoft is influenced by overall market trends, it also exhibits unique behavior due to its position as a high growth technology stock. The practical takeaway here is diversification. By including assets with lower or moderate correlations, we can reduce the overall risk of the portfolio while maintaining returns. For instance, Microsoft being less correlated with the VTI and the S&P 500 acts as the diversification tool. Here coming to the slide 11. Here I'm going to explain about the visualization distribution of returns for assets. This slide shows the distribution of daily returns for each of three assets using density plots. Here the Microsoft, this distribution is wider with greater dispersion around the mean. This reflects its higher volatility and greater potential for extreme positive or negative returns. In the VTI, it is distribution is more centered, indicating moderate volatility and more stable returns. And coming to S&P 500, the distribution is the narrowest, which aligns with its low risk, low return profile. The practical implication of these distributions is in portfolio construction. For example, an investor seeking higher returns but willing to accept greater risk might prioritize Microsoft. A conservative investor looking for stability might prefer the S&P 500. VTI offers a balanced middle ground, making it a versatile choice in portfolio optimization. This visualization reinforces the need for diversification as combining assets with different risk return profiles can lead to a more efficient portfolio. And coming to the slide 12, here I'm going to explain about the optimization weights. This table summarizes the optimal portfolio weights for the three optimization models. Risk minimization allocates 50% to Microsoft and 50% to VTI. This model avoids the S&P 500 because Microsoft and the VTI are together offer better risk reduction potential through diversification. Sharp ratio maximization. It allocates 100% to VTI. This reflects VTI's ability to deliver relatively higher returns with moderate risk, making it the most efficient choice for a balanced risk return trade off. And coming to the return maximization, it also allocates 100% to VTI, prioritizing growth potential. These weight distribution highlight the strengths and trade-off each model. The risk minimization model balances risk by splitting allocation equally between Microsoft and VTI. The Sharp ratio maximization model focuses entirely on VTI given its superior risk adjusted returns. The return maximization model aligns with aggressive growth strategies but doesn't diversify as it focuses solely on VTI. And coming to the slide 13, I'm going to explain about the performance metrics. This slide presents the key performance metrics for each model. First one, expected return, reflects the average return the portfolio is expected to generate, and the variance measures the portfolio risk or volatility. And the Sharp ratio evaluates the efficiency of each portfolio in terms of risk adjusted returns. The risk minimization. This model achieved the lowest variance, making it the least risky option. However, its expected to returns was also the lowest and its Sharp ratio indicated inefficiency in risk adjusted performance. And coming to the Sharp ratio maximization, this model delivered the best risk adjusted returns. While the expected return was not the highest, its Sharp ratio indicated an optimal balance between risk and return. And coming to the return maximization, as expected, this model achieved the highest expected return. However, in Sharp ratio was similar to that of the Sharp ratio maximization model, indicating that the additional risk taken didn't proportionally increase the risk adjusted return. These metrics demonstrate the trade-offs inherent in each strategy, guiding investors to choose the model that aligns with their goals and risk tolerance. And from here, my friend Gautam is going to explain the rest of the slides.
Hi everyone. Here we can see the optimization metric comparison matrix, where we have compared the three models of the key metrics like expected return and the risk variance and the Sharpe ratio. Here from the graph, we can see that the risk minimization expected return is minus 0.0253, which is the lowest one, and the variance and the Sharpe ratios effectively least. In the Sharpe ratio maximization, we got the expected return as minus 0. Nearly equal to 0, and the variance as 0.01712. And the return maximization metrics, we match the Sharpe ratio maximization model and indicating the identical portfolio results in this case. So from these three comparison, we can say that the risk minimization model has the lowest variance, but also the lowest expected return, making it more suitable for the ultra conservative investors. And the return maximization model has achieved the highest expected return, but comes with the highest risk. Overall, from the three models, we can say that the Sharpe ratio maximization model stands out as the most versatile option, comparing to investors who seek a balance between the growth and the stability, such as minimizing risk or maximizing returns, may prefer the other models. Coming to the next slide, we can see the key findings. Our key findings highlight the strengths and the trade-offs of the three models. Coming to the first model, risk minimization model is the best model for investors who prioritize stability. It minimizes risk effectively but sacrifices returns and risk adjustment performance. Coming to the next model, Sharpe ratio maximization model is the most effective option compared to all the three because it offers the best balance between the risk and the returns. It's ideal for investor seeking moderate growth with manageable risk. Coming to the return maximization model appeals to aggressive investors who are willing to take higher risk in pursuit of the highest returns. However, this model is a risk-adjusted performance similar to that of a Sharpe ratio maximization model. These findings underline the importance of aligning the portfolio strategies based on the individual investor profiles. Like some choose to get the highest risk, and some other choose to get the lowest risk with maximum profits. Coming to the next slide, on the basis of the performance of the three models, we have analyzed and finalized the Sharpe ratio maximization model is the recommended portfolio because it delivers the best risk adjusted returns, ensuring that the investors get the most out of the every unit risk they take. It provides a balanced approach, making it versatile for the investors to suit a wide range of from moderately conservative to moderately aggressive models. While risk minimization and return maximization models cover the least risk compared to Sharpe model, making it robust choice in most scenarios. This model is particularly valuable in volatile markets where manageable risk effectively is just as important as seeking a result. Overall, our studies show that the Sharpe maximization has achieved the best for the investors. Moving to the next slide. Finally, these are the references and the ground basis for our project, which has a combination of fundamental theories and the references we took from. Thank you for your attention and have a good one.
Thank you.